Are interest rates quietly steering your stock returns? Here's why tracking yields could be the edge your portfolio needs right now. Markets are once again taking their cues from rates. Goldman Sachs notes that the link between equities and yields is shaping valuations, sector leadership, and factor performance. With the Fed and inflation in focus, changes in discount rates are flowing straight into stock pricing. If you're watching earnings and headlines, understanding how rates transmit into equities is now central, not optional. This linkage matters because it hits both what investors will pay and what they think they'll earn. When yields rise, long-duration assets feel it first. Growth companies that expect more of their profits in the future see faster multiple compression. Meanwhile, cash-generating, rate-sensitive groups can hold up better. When rate expectations ease, those longer-duration equities often rebound and risk appetite broadens. The correlation itself has shifted with the macro regime. In disinflationary expansions, falling rates often aligned with stronger risk appetite. In inflationary episodes, higher yields sometimes tracked better growth and earnings. Today, the linkage is more data-dependent and regime-sensitive, so the sign and strength can flip quickly. Valuations amplify the impact, with price-to-earnings ratios elevated versus long-run medians in many large-cap benchmarks. Small moves in discount rates matter more. A PE of 20 implies a 5% earnings yield. A 1 percentage point change in the discount rate can meaningfully alter the present value of long-dated cash flows. That is why rate repricing can swing indices and styles in days, not months. Style factors have rotated with financing costs. Quality and profitability profiles find support when borrowing gets pricier, because resilient margins and balance sheets matter more. When the forward path of rates flattens, higher duration growth can re-rate and leadership can broaden. Policy is the anchor. The Fed's rate path, set across its scheduled meetings, now frames cross-asset positioning. Investors are reassessing duration risk not only in equities, but also in credit and multi-asset portfolios. During these periods, earnings season can be overshadowed by shifts in the forward rate path, and dispersion widens across sectors and styles. That raises risks for passive exposures and opens doors for selective, active positioning. Here's the practical takeaway. Map your portfolio's duration. Stress test valuations against plausible rate paths. Favor balance sheet strength when financing costs rise, and be ready to pivot toward longer duration growth if easing becomes credible. Watch the equity risk premium relative to risk-free yields. It remains the bridge between rates and required returns. Want the full breakdown and examples? Read the full article at finlitica.com.